Hi there, I'm Dean Heskin, President and CEO of Swiss America Trading. Thank you for tuning into our podcast, The Secret War on Cash, where we take an in-depth look at some of the things happening in our economy and our financial markets, not just domestically, but globally or abroad as well. And a hot topic in the news recently, for obvious reason, because it's on the table, is what's been going on with interest rates. And we're going to start off with that. And to do so, I'm going to bring my co-host in. There he is. CC already brought him. Chris Agelastos. Chris, thanks for joining us today.
Yeah, happy to be here. Thank you.
Well, let's talk about interest rates. This is coming out of Watcher.Guru, Chris. Fed no longer projected to raise interest rates in September. Okay. So this has been, as I mentioned in the opening of the show here, a much talked about topic. And I mean, these rate moves at this point, they wouldn't be astronomical to begin with, but I mean, it is, I think, more than anything, if and when they choose to raise rates, it is going to be a signal that's sent. And,
Right.
You know, the market's been talking about it and expecting it. And I think it's going to be, I guess my question with it is, Chris, is like, the market has been so engrossed in what the Fed is going to do with rates. Number one, I don't think a rate increase is going to change anything as far as inflation or anything of substance. Let's put it that way. I think that horse left the barn a long time ago. But also, even with the move in rates at this juncture, I'm kind of the belief that the market's kind of already factored it in, plus or minus, one way or the other. You know what I mean? Like if they lower them or raise them, it's already there. So, I mean, from your perspective, do you think that this is by them raising rates? Let's just say they decided to, or at least let's just say even leaving them like they're going to. Do you think this is going to move the needle one way or the other as far as markets and the economy goes?
No, not as long as these predictions are right. So as long as they don't raise rates, that's already priced in, but if they unexpectedly raise rates or unexpectedly drop rates, which are very unlikely in this scenario, that can move the needle. Although, does it really move it long term? No, not really. It would be some short term effects, and then the market would reprice itself, and then we'd be off to the races again. So I don't expect any major changes in September. But again, if they go, if they go a way that we're not expecting, it could cause a couple of ripples. But a lot of times too, that creates buying opportunities for people. I think the real thing here that I find interesting is just how much it volleys back and forth. I mean, just a few months ago, President Trump was really pounding on the Fed, trying to get them to lower rates.
Right.
Then it looked like actually what's going to happen is maybe they're going to increase rates. And now we're at a point where, okay, maybe they're going to stay flat. So nothing is changing. Yet we've had predictions that they were going to go down and go up all in the last several months. But what they're citing in here is mostly just unemployment numbers, and they're hesitant. Where inflation is, they really probably should be increasing rates just to kind of make a move towards reducing inflation. But with the job market being what it is right now and weaker employment numbers coming in, they're really hesitant to do so. So I think it's going to be status quo for the next couple of months. But what is good about that for us and for our clients is that flat interest rates where they currently are, and inflation staying up where it is should be a good tailwind for gold prices. So even just in the last couple of weeks here, I think we've seen a couple $100 an ounce about positive movement in the gold price. So we're predicting that we're going to continue to see that over the next few months.
Right. Well, and that's what I'm saying. That speaks to the fact I think the markets have already, to a great extent, already kind of factored this in as a
Figured it out. Yeah.
Right. But let's talk about something very interesting as we talk about our rates, which rates by and large are pretty low right now, all things considered. I mean, it's not like we're talking about 5, 8, 10% rates or anything like that. This next article here from Zero Hedge. So they're looking at Japan, and we talked about Japan in earlier podcasts. The the title here, the financial equivalent of all-out nuclear war. Jim Rickards says, "Yentervention," which is a kind of a cool term, funny term, is the biggest story in the world. Okay, so as the U.S. became involved in, trying to circumvent this mass sell-off and exodus of dollars, treasuries, et cetera, from Japan. So what Rickards talks about, and I'll quote here in the article, he said, somebody wrote me and asked me if the yen carry trade is a big deal. Okay, because it happened, and really there wasn't a whole lot of fanfare about it here in the United States. I would say financial news. I mean, it was talked about, it was written about, but it wasn't like really a big deal.
Yeah.
So what Rickard says, he wrote them back and said, there is nothing bigger. This is actually the biggest story in the world. Now, isn't that interesting? As we're looking at what's happening in the Middle East, we're talking about what's happening with inflation. BRICS has been relatively quiet, all things considered. This is, Rickards is saying, is actually the biggest story in the world. And I'll let you kind of talk about it, but what I also found interesting, you skip down to the article just a few sentences. He writes, the thing that could go wrong the fastest is if Japanese interest rates went up. The Bank of Japan says it's going to keep raising interest rates. It's not going to the moon, but 3% for the yen and Japanese interest rates is like going to the moon when it's been 0% for 20 years. Okay. Right. And the reason I want to kind of highlight that is because that's been a concern of mine for a long time with the United States, is we have kept our rates pretty artificially low. And there's reasons for that, ladies and gentlemen. Part of it is if rates are low, it allows us to, our government, which lives off of and thrives off of debt and borrowing, if the rates went from current levels even up a point or two, our cost of money, our cost of borrowing goes up immensely. And that's what they're talking about here with Japan. And that's my concern for the United States, and always has been, that if and when we do start moving rates, that's probably one of our biggest vulnerabilities.
Yeah, and what I didn't realize myself here is how much borrowing actually takes place in the yen, because it's so inexpensive at zero or near zero rates, that they can then invest that money in other assets, other currencies, other nations, right? Other global companies, and get a good return on their money, and they're not really paying any interest on that borrowed money, or very little. And it's a much larger market than I realized, and that's what really could cause problems here. Obviously that's one of the reasons why the U.S. is intervening and trying to help the yen here, is because, selfishly speaking, right, that will in turn help us, versus not helping them and having a potential unwind, cause a collapse here. So it is interesting that nobody else, even though people are talking about the U.S. intervening with the yen, and like you said, there's been some headlines and some casual conversation about it. I don't believe anybody other than Jim Rickards has brought up this major point. And so, kudos to him for being on top of it. And I'm almost wondering why other people aren't talking about it. And I wonder if maybe they want our heads in the sand a little bit, because I think if people really realized how precarious the situation is, maybe they would be making different decisions with their money, and that could greatly affect our stock market here in the U.S. as well.
Right. Absolutely right. Well, and Chris, as you're talking about that, it again speaks to exactly just not only the vulnerabilities that exist out there, the minefield of issues that exist out there, but the whole domino effect potential that exists out there, where it's, everybody is kind of on their own pins and needles right now, because once one system starts to fall, you're going to find that the successive impact of that is going to be tremendous. And again, this is why banks, institutions, and hopefully individual investors are buying up metals, getting themselves diversified, so they're not held vulnerable to fiat monies or to assets that are basically a glorified version of debt that requires some kind of a payback or making good on it, getting into things, real estate as well, where it's not going to evaporate on you. Those are key items right now. So, well, I think this is definitely going to be something to talk about. And Certainly watch here in the remainder here of 2026, which is already quickly
rapidly approaching. Yeah.
coming to an end. Yeah. So, but anyway, well, thank you, Chris. And for those of you tuned
Yep.
in, thank you for doing so. Follow us on social media if you're not doing that. If you're not subscribed, please do that as well. If you'd like some more information from us about the secret war on cash, about metals, about maybe even taking a retirement account or an IRA and diversifying that into metals, all of that is something that we can answer your questions. And if it sounds good to you, get you pointed in that direction. You can do that by calling or texting at 1-800-289-2646, or you can visit us online at SwissAmerica.com. Thanks for tuning in, and we look forward to talking to you more in the future. Have a great rest of your day, great rest of your week, and we'll see you soon.
Take care.